Tom Lee, head of research at Fundstrat and chief investment officer of Fundstrat Capital, joined Squawk Box to share his take on the latest market trends, the impact of the U.S. Israel conflict with Iran, the state of the AI trade, crypto outlook, and more. And his big call is this: March is going to be an up month for the stock market. In this video, I'll first show you the clip of Tom Lee on CNBC. Then I'll break down my own reaction to what he said, and finally, we'll dive into an in-depth analysis of 3 best defense stocks to buy now. Make sure to hit the like button, share this video, and leave your thoughts in the comments. Subscribe so you don't miss the next key investing update. Let's hear what Tom Lee has to say.
Joining us now, Tom Lee, Fundstrat Global Advisor, head of research, and a CNBC contributor. Could be down, obviously, a lot more. Straits of Hormuz maybe in play at this point. In past incidents like this, and every single time it's happened, we've always said, well, in past incidents, it never lasts that long, and decisions that are made about whether staying in or getting out of a market, normally standing pat has been the right move.
That's right. I mean, nobody likes to see headlines and the images of explosions and war. And so we know risk premium jumps. That's why the VIX jumps. But it's not really going to change the fundamentals of the U.S. So in the past, markets kind of sell off into the buildup, and then they tend to do better once the battle begins. And I think this is going to be similar.
We got to watch across the board, obviously, gold and the yield curve, but oil, obviously, oil. It won't affect us in the economy at this point, but I guess there's a scenario where down the road it could, isn't there?
Yeah. I mean, I think a lot of experts are going to worry that this could, encompass a larger conflict, something that would be, World War III or something.
Right.
But in the absence of that, I think the worst of the sell-off is going to happen this week. And, I would expect actually March to be an up month for the stock market.
What about the price of oil, which has been such a huge benefit, lower prices of oil to the economy, to the consumer? I realize that we are self-sufficient, but a lot of other countries aren't. If you look at China, if you look at India, Japan, is there a point that it gets more expensive, and if it gets more expensive for China, that is then exported to the rest of the world?
Yeah, I mean, oil's going to create a price shock because oil, it ends up so much in the economic supply chain.
Even what we produce here is going for 72 now, so it doesn't matter whether, we got plenty of it, but oil companies are obviously going to reap some benefits, but consumers, this will filter through in a time when we're still inflation phobic, I think.
That's right. In the past, oil shocks are actually more at risk of maybe tipping a weak economy into recession.
And that's not where we are.
Yeah. And so I think instead of thinking the Fed would be hawkish, I think the Fed might be dovish on a spike in oil.
This market is not doing things that you didn't think it might do at the beginning of the year. And it had nothing to do with what the developments of the past week. Block. That makes people think AI is, maybe we're underestimating, unless this is the same guy that had 3 times as many at Dorsey, 3 times as many employees at Twitter as was necessary to run that outfit. So I don't know whether you paint a broad stroke about AI with what happened there, or whether this is a one-off. I tend to think we better get used to this, no?
Yeah. I mean, I know many companies that are rolling out AI workers. Even at Fundstrat, we are deploying these agents and, treating them as if they're employees. But I think we're still unsure whether or not this will ultimately create more jobs or not.
And AI is killing will kill a lot of companies. And AI itself, the killer is, you could say, had such a run that it is at least richly valued.
Yeah. And, at least in the case of the software stocks broadly, the entire complex kind of has fallen back to where they were last April. To me, that's clearly an overreaction. So I think it makes sense that you'd start to see some of the groups that got hit hard mean revert, including the Mag 7.
So I think someone else made that point, that maybe the leaders in building out AI maybe they stay where they are and stabilize, but maybe you get a rebound from some of the oversold things.
Yeah.
So you think we're getting to the point now where the initial weakness you saw in the markets, we're making a bottom at some point? What do you say will be up for March?
Yeah, I think March is going to likely be an up month. I know it doesn't feel like that because of the way the end of February felt. But
comes in like a bear, goes out like a bull.
Yeah. It probably comes in with the better weather. But, the things like software, the Mag 7, and the crypto all had early weakness. They're all probably in the final stages or have already bottomed. And I think that helps lead us up to an up April.
Have you woken up in the middle of the night and looked at where Ethereum is and said, I can't go back to sleep?
No.
You're not worried yet?
No, because, Ethereum, there's the fundamentals, like what's happening. So much is being built on Ethereum now. I mean, almost every major announcement of a tokenized fund is being built on Ethereum. Does that
translate to supply and demand dynamics that make the price go up, though? Or can you just keep building out all these networks at 1900?
I mean, that would be like someone saying all this activity is happening in the United States, but the economy shouldn't boom, Yeah. So if it's all taking place on Ethereum, then price follows. But we are in a crypto winter, so price doesn't matter. Capital is looking at gold and silver and ways of, hard assets. But that isn't always going to be the case.
I'd read you buying more Ethereum on the dip. How much more, and does that continue today?
Yes. So Bitmain's been buying about $50,000 or about $100 million of Ethereum every week, but the cash balance has grown to over 800 million. So it's able to, at the right moment, make a major buy of Ethereum. So I think we're getting ready for the crypto bottom. But we're still buying about 100 million a week.
All right.
After watching this interview, the first thing that stands out is the tone. The market was clearly under pressure going into the conversation, with futures sharply lower and the Dow Jones down over 1%. The backdrop was geopolitical tension and fears around conflict escalating in the Middle East. What Tom Lee immediately tries to do is calm the emotional response that markets often have to these kinds of headlines. He acknowledges something important that people forget in real time, which is that markets hate uncertainty and violent imagery. When explosions and war dominate headlines, risk premiums spike, volatility jumps, and that is exactly why you see the VIX surge. But his core argument is that this does not automatically mean the fundamentals of the U.S. economy have changed. Historically, he points out that markets tend to sell off during the build-up phase of conflict, not necessarily during the conflict itself. Once the situation becomes more defined, markets often stabilize and sometimes even rally. I actually agree with him here. Time and again, investors overreact to the unknown, and once the fog clears, capital starts flowing back into risk assets. That does not mean geopolitics do not matter, but it does mean that panic selling has rarely been the winning long-term strategy. The conversation then shifts into oil, which is where things get more nuanced. On the surface, higher oil prices are not immediately crippling for the U.S. economy, because the U.S. is far more energy independent than it was decades ago. But Tom makes a key distinction that I think many people overlook. Even if we produce our own oil, oil is still priced globally. If oil is trading in the $70 range or higher, that price flows through the entire supply chain. Energy companies benefit, but consumers feel it everywhere else, from transportation to goods and services. Where I really liked his analysis is when he framed oil shocks in historical context. Oil price spikes are most dangerous when the economy is already weak. In those cases, they can tip a fragile system into recession. His view is that this is not the situation we are in right now. The economy, while slowing in places, is not fundamentally broken. Because of that, he actually believes the Federal Reserve could become more dovish if oil spikes, rather than more hawkish. That is a subtle but important point. Many investors assume higher oil equals higher inflation equals tighter policy, but if oil acts more like a tax on consumers and slows growth, the Fed may be forced to look through it. Personally, I think this is one of the most misunderstood dynamics in the market right now. People are still trading like every inflation data point automatically means rate hikes. The reality is more complex, and Tom is basically saying the Fed cares about economic damage as much as inflation optics. The interview then pivots to artificial intelligence and technology stocks, and this is where things get especially interesting. There is a clear acknowledgement that AI is disruptive and that it is already replacing certain roles. Tom even admits that firms, including his own, are deploying AI agents and treating them like employees. That is a huge statement if you really think about it. At the same time, he is honest enough to say, we do not yet know whether AI ultimately creates more jobs than it destroys. My own take here is that both sides are probably right. AI will eliminate entire categories of jobs, but it will also create new ones we cannot fully define yet. The transition period is going to be messy, and markets are trying to price that in real time. That is why we see so much volatility in software and AI-related stocks. When the discussion turns to valuations, Tom argues that the sell-off in software stocks looks like an overreaction. Many of these names have fallen back to levels seen last April. In his view, that creates an opportunity for mean reversion, especially in the biggest and most influential companies, including the so-called May G7. I tend to agree with this, with one caveat. Mean reversion works best when fundamentals remain intact. If earnings continue to grow and balance sheets remain strong, these pullbacks are opportunities. If growth disappoints, then cheap can always get cheaper. What I found compelling is his broader market call. Despite how ugly the end of February felt, he believes March is likely to be an up month. That sounds almost counterintuitive given the mood in the market, but that is often when markets bottom. His argument is that many risk assets, including software, big tech, and crypto, have already gone through early weakness and are either bottoming or close to it. That sets the stage for a recovery not just in March but potentially into April. The crypto portion of the interview reinforces this theme. When asked about Ethereum, Tom is clearly not panicked by price action. His focus is on fundamentals. He points out that an enormous amount of development is happening on Ethereum, including tokenized funds and financial infrastructure. His analogy is simple but powerful. If economic activity explodes in a country, eventually the economy grows. If activity explodes on a blockchain, price should eventually follow. That said, he also acknowledges we are still in a crypto winter mindset. Capital is hiding in hard assets like gold and silver, and speculative appetite is muted. In my opinion, this is exactly why long-term investors pay attention during these phases. When fundamentals improve but prices lag, that disconnect does not last forever. The interview closes with discussion of institutional buying, including companies accumulating large amounts of Ethereum. That detail matters because it signals confidence beneath the surface. Quiet accumulation during periods of fear is often how major trends begin. Stepping back, my overall takeaway from this interview is that Tom Lee is not dismissing risk. He is contextualizing it. He is saying that geopolitics, oil shocks, AI disruption, and crypto volatility all matter, but none of them automatically invalidate the broader bull case if the economy remains resilient. I think that is a balanced perspective, and one that is easy to lose when headlines are screaming and markets are red. Now let's dive in and talk about the 3 best defense stocks to buy now with the ongoing U.S.-Iran conflict escalating at the moment. Let us start deep and strong with a company that many investors already know by reputation but few truly appreciate in terms of structural advantage. I am talking about Lockheed Martin Corporation, ticker LMT. Lockheed Martin is not just another defense contractor. This is arguably the most strategically essential defense manufacturer in the world. When we talk about durable competitive advantages in this industry, Lockheed does not just check the box, it defines the box. At its core, Lockheed Martin builds platforms that are literally at the backbone of modern military capability. Fighter jets, missile defense systems, radars, space systems, and critical avionics are not products that are easy to replicate. Governments do not simply swap out suppliers like consumer brands. The barriers to entry here are immense. The expertise to produce an advanced fighter jet goes far beyond engineering and manufacturing. It requires cutting-edge aerospace research, decades of classified collaborative work with national defense agencies across the globe, and certifications that take years to earn. When investors think about Lockheed, the first thing to understand is that this is a company whose customers do not behave like retail customers. The United States Department of Defense is Lockheed Martin's largest buyer by revenue. That is not a casual buyer. That is a customer with multi-year budget cycles, with mission-critical needs, and with little tolerance for failure. When the DoD awards a contract, it normally involves hundreds of millions or billions of dollars and delivery timelines that stretch for years. That structure creates enduring revenue visibility. At a time when many sectors face cyclical downturns, Lockheed Martin has a backlog of future work that is measured in years, not quarters. For Q4 2025, Lockheed reported sales well north of $41 billion and a robust profit margin that remains among the strongest in the sector. Its book-to-bill ratio, which measures new orders against revenue delivered, stayed above 1. meaning Lockheed booked more contracts than it fulfilled last quarter. That is a critical signal of growth potential. A backlog in the aerospace and defense sector is not inventory sitting on a shelf. It represents future revenue that has already been contracted and will be recognized when products are delivered or services are rendered over the next several years. Lockheed's business segments are diversified but highly synergistic. The aeronautics division includes the F-35 Lightning II program, one of the most sophisticated fighter platforms ever developed. The Rotary and Mission Systems division delivers naval combat systems, missiles, and radar technologies. The Space Division works on satellites, exploration systems, and national security space operations. Missiles and Fire Control is focused on advanced weapons systems that are critical in modern deterrence strategies. Each of these segments feeds into the other in terms of engineering platforms, shared technologies, and economies of scale. Now let's talk about competitive moats. Why is Lockheed not vulnerable to upstarts or foreign competition? One reason is intellectual property and classified technology. Lockheed's platforms rely on cutting-edge defense innovation that cannot be duplicated easily without access to the same level of classified research and national security clearances. The cost, time, and regulatory barriers to replicate these systems are prohibitive for any competitor. A second reason is long-term government contracting. Once a company like Lockheed earns a government program award, the relationships and contract structures are multi-year and often multi-decade in scope. These contracts often include recurring revenue, maintenance requirements, and future upgrades. Governments rarely shift away from a supplier once they are deeply integrated into mission-critical infrastructure. Third, Lockheed's scale and supply chain reach are unmatched. The company partners with thousands of suppliers around the world, and its processes are refined through decades of delivery. The economies of scale here are real, and that means Lockheed can operate more efficiently than smaller competitors. From a growth perspective, Lockheed Martin's geopolitical positioning is a tailwind, not a headwind. When global tensions rise, nations expand defense budgets. That has been a consistent trend across NATO allies, the Middle East, and parts of Asia. The Russian invasion of Ukraine, the ongoing security dynamics in the Indo-Pacific, and broader national defense modernization programs globally are all increasing demand for defense capabilities. Lockheed is deeply embedded in those spending patterns. Now let us talk numbers with context you care about as an investor. For Q4 2025, Lockheed Martin's revenue was driven by sustained demand across its core divisions, with particular strength in the aeronautics and missiles segments. Profit margins remained strong despite inflationary cost pressures in certain manufacturing inputs. This tells us Lockheed has pricing power and supply chain resilience. Some companies see margins compress when costs rise. Lockheed has so far been able to manage those pressures while preserving shareholder value. Lockheed also returned capital to shareholders through dividends. The dividend yield, while modest compared to high-yield sectors, is stable and supported by strong free cash flow. More importantly, the dividend is sustainable. Lockheed has a history of increasing dividends over time as profitability grows. For long-term investors who care about income plus growth, that is a powerful combination. Another dimension worth noting is Lockheed's valuation. Defense stocks sometimes trade at premiums due to their stable earnings, predictable revenue streams, and strategic importance. That can make new investors nervous. But one thing you should be paying attention to is valuation relative to future growth. Lockheed's earnings forecasts have remained resilient, and analysts see earnings per share continuing to grow as backlog work gets recognized in revenue. Perhaps the most important point for long-term investors is the predictability of cash flows. When you invest in Lockheed Martin, you are investing in a business where future work is already under contract and where demand is structurally supported by national security priorities that are unlikely to shrink meaningfully in the coming decade. So the question you have to ask yourself is this: are you investing in businesses whose growth is dependent on market cycles and consumer tastes? Or are you investing in a business whose growth is embedded in multi-decade spending priorities of sovereign governments around the world? If you want something that has been battle-tested, with real competitive moats, real revenue visibility, and real long-term demand drivers, Lockheed Martin is exactly that type of business. And now, before we move to the next defense stock, I want to take a moment to highlight a message that can help you take your investing skills to the next level, especially if you are serious about identifying stocks like LMT consistently. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Next up, let's talk about RTX Corporation, ticker symbol RTX. This is a company that has quietly become a cornerstone of both aerospace and defense, combining decades of innovation with some of the most critical technologies in military and commercial aviation. RTX is not just a manufacturer, it is a solutions provider that spans multiple layers of national security, aerospace, and technological infrastructure. When you think about durable competitive advantages, RTX is a perfect example of how scale, diversification, and advanced technology create a business almost impossible to disrupt. RTX's structure is particularly compelling because it operates 4 major divisions that cover almost every angle of aerospace and defense. Pratt & Whitney is responsible for engines that power some of the most advanced fighter jets and commercial aircraft in the world. Raytheon Missiles & Defense focuses on missile systems, integrated defense solutions, and precision technologies that are critical to modern military operations. Collins Aerospace delivers avionics, flight control systems, and other essential components for both commercial airlines and defense applications. Finally, Raytheon Intelligence & Space handles advanced sensors, cybersecurity solutions, and space systems that are increasingly central to global defense strategies. Each of these divisions contributes not just revenue but strategic depth, creating multiple revenue streams and long-term contracts with high switching costs for customers. One of the things that sets RTX apart is how its technological complexity forms a moat. Developing advanced propulsion systems, missile defense technology, or space-based sensors is not something a competitor can replicate overnight. It takes decades of R&D investment, certified manufacturing processes, and trusted government relationships. That combination creates a barrier to entry that is almost insurmountable for new competitors. From a financial perspective, RTX is performing solidly. For the most recent quarter in Q4 2025, the company generated around $37 billion in revenue. That growth reflects strength across all 4 divisions, with notable contributions from Raytheon Missiles & Defense and Pratt & Whitney. Margins remained robust even in the face of inflationary pressures on raw materials and labor, which speaks to RTX's pricing power and operational efficiency. Backlog levels are also impressive, providing revenue visibility that stretches for years. When you consider that a large portion of RTX's revenue comes from government contracts with multi-year delivery schedules, you start to see why this business is so resilient. Another key advantage for RTX is its ability to return capital to shareholders while continuing to invest in growth. The company has a consistent dividend policy supported by strong free cash flow, alongside a share repurchase program that adds value to existing shareholders. This balance of income and growth is appealing for long-term investors who want exposure to a defense business that combines predictability with upside potential. Geopolitical dynamics are another important factor in RTX's outlook. The modernization of defense infrastructure across Europe, Asia, and the Middle East is driving demand for advanced missile systems, propulsion technology, and cybersecurity solutions. RTX is well positioned to capture these trends, but it's not just about current contracts. The company is actively innovating in areas like hypersonics, autonomous systems, and space technologies, which positions it for the next generation of defense needs. That forward-looking focus is what differentiates RTX from companies that only benefit from current government spending cycles. When you think about investing in RTX, it is essential to recognize the structural advantages. The combination of technological expertise, diversified revenue streams, high barriers to entry, and multi-year government contracts creates a business that is extremely hard to replicate. And from a strategic perspective, the company's scale allows it to invest in innovation while remaining profitable, a combination that many smaller competitors cannot match. For long-term investors, RTX offers more than just a defensive play. It is a business that can grow steadily, deliver consistent cash flows, and adapt to future defense priorities. That predictability and forward-looking growth potential are exactly what makes it one of the best defense stocks to consider today. Now let's move on to the third stock on our list, a company that is quietly one of the most strategically important in U.S. defense and national security. That company is Northrop Grumman Corporation, ticker symbol NOC. This is a company that operates at the cutting edge of defense and national security technology, from advanced aerospace systems to autonomous platforms, missile defense, and space operations. Northrop Grumman is quietly one of the most strategically critical companies in the world. Its work is essential to the United States and allied nations, and the combination of scale, technological expertise, and long-term government partnerships gives it a durability that is rare in any industry. Northrop Grumman's business spans several key areas that are integral to modern defense. Its aeronautics systems segment produces advanced aircraft and autonomous systems that are shaping the future of air combat. Defense systems focuses on integrated solutions, including missile defense, radar, and combat systems, all designed to meet the most demanding operational requirements. Mission systems and space systems cover everything from cutting-edge sensors and cybersecurity solutions to satellite platforms that are increasingly critical to global security. The company's portfolio is broad, but every division contributes to a cohesive ecosystem of advanced defense capabilities. One of the reasons Northrop Grumman stands out is its strong technological moat. Developing autonomous aircraft, hypersonic systems, or advanced space platforms requires decades of R&D, top-level engineering talent, and partnerships with government agencies that have incredibly high standards. A competitor trying to enter this space would face enormous barriers, both in terms of technology and trust. Once governments integrate Northrop Grumman systems into critical operations, switching costs are extremely high, which creates a long-term revenue advantage. Q4 2025 financial results underline why NOC is so attractive to investors focused on durability and growth. Revenue exceeded $30 billion, driven by continued strength across aeronautics, mission systems, and space systems. Margins remained robust despite inflationary pressures in materials and labor, demonstrating operational efficiency and pricing power. And the company's backlog is massive, exceeding $80 billion, which provides years of revenue visibility and a multi-year runway of predictable cash flows. Northrop Grumman also returns value to shareholders through a combination of dividends and share repurchases. Its dividend yield may not be the highest in the market, but it is fully sustainable and backed by strong free cash flow. For long-term investors who want both stability and growth, that combination is highly attractive. From a strategic perspective, Northrop Grumman benefits from global trends in defense modernization, space programs, and autonomous systems. Countries are increasingly investing in next-generation defense capabilities, including missile defense, cyber warfare, and space-based operations. Northrop Grumman's portfolio positions it to capture a significant share of that spending. This is a company where long-term relevance is not dependent on short-term market cycles, but on structural demand for advanced national security capabilities. Investing in Northrop Grumman means buying into a company with predictable revenue, a diversified portfolio of advanced technologies, and a proven track record of delivering critical defense systems. It is a business that can grow steadily, weather geopolitical uncertainty, and remain essential to government operations for decades. That combination of predictability, innovation, and strategic positioning is exactly why Northrop Grumman is one of the best defense stocks to consider right now. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Here is a question to leave in the comments for discussion. Considering the long-term advantages, technological moat, and government contract visibility of RTX and Northrop Grumman, which company do you think is better positioned for sustained growth over the next decade, and why? I want to see your reasoning and your comparison between these two dominant defense players. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.